Let's do some trading. Let's look at some charts, and let's talk about whether or not this is the real deal rally. Joining us, Gareth Soloway is the chief market strategist at InTheMoneyStocks.com. All right, Gareth, so is this the real deal? I mean, S&P taking, I think it's the fourth swing at 4,000. Is this going to be a home run, or what's going on? We go back to the dugout.
Yeah, so thank you for having me back. It's always a pleasure.
Thank you, sir.
So there's no doubt about it. You got this amazing bullish sentiment out there. Risk on. We see it in cryptocurrencies. We see it in stocks. We even see it in some effect in gold and in oil. But for me, I'm not buying it. I think the market is coming off of this, what I call the January effect, where you had all the tax loss selling taking care of a lot of sellers in December. That kind of makes the markets generally buoyant in January. Then you throw in the mix of the Fed obviously coming down to the wire in terms of just hiking another 25 basis points, maybe a couple more times, and the market's getting that giddiness. Remember, the market looks 6 months out. So they're saying, okay, within 6 months, the Fed's done hiking. What they're not recognizing to me is that the Fed will not be lowering rates in 2023.
Okay, so that's still where the gap is. We might stop hiking, but we're not going to start cutting.
Yeah, that's exactly right. And the thing is, I mean, it's just common sense in that you have inflation that, yes, it's coming down. The first chunk of inflation, it comes down quickly. That last little bit from 4% to 2% is going to be really, really sticky due to wage increases and all these other factors. And that's going to keep the Fed very nervous about replicating what we saw with Volcker back in the 80s, where inflation roared back. And they're going to be very, very careful not to lower rates until things economically get so bad. And I'm not talking about 5% unemployment. I think the Fed would wait until probably beyond 5% unemployment before they even think about cutting rates.
So how do we trade that timeline, Gareth? I mean, if the real breakdown in the macro narrative is going to happen when we can't go from 4 to 2%, I think it's a very good logic and seems like it could be a major problem. That may not be obvious for, 6 months. Do we follow what the Fed tells us they're going to do? Because the market doesn't seem to be prioritizing that. The market knows they're saying no cuts. We're rallying anyway.
That's right. And the market is just kind of going on this hopium, which you understand, right? I mean, the market has been conditioned for the last 10, 15, 20 years to really always think that the Fed will bail them out, even when the Fed talks tough. And so I think the market is going back to the old playbook of saying, hey, listen, let's react to what the Fed does, not what they say, versus them saying right now they're going to be harsh and not lower rates. And ultimately, I think that's where the market's having a disconnect. But like you said, it doesn't mean the markets can't rally in the near term. I just think we have to be very aware that the Fed, there is going to be a cliff at some point where the market says, wait a minute, yes, the Fed's done hiking, but we're not going to see these cuts. There will be a day of reckoning where they realize that.
What do you look at right now and see as an opportunity then? Is your participation lower until some of this macro thematic stuff comes to fruition, comes to reality? Are the moves gone if you missed it, Bitcoin and stuff like that?
Yeah, so for instance, I think Bitcoin at most has upside to about 25,000. 25,000 to me is a confluence of major resistance. Okay. So I'm going to actually start to look to short it around that level if we hit that in the next couple days or weeks. And then on the other side, there's some opportunities on the short side. Like I started to nibble at a short on Apple today. That's hitting a key gap fill, a technical trend line, and also even natural gas. I mean, there's always opportunities in the market. Natural gas hit the $3 level, which is a major technical support. It's down something like 50% in the last couple months. There's a swing trade opportunity there for a snapback to 360 or so, which again, in this market, you just kind of look for these little opportunities and kind of print money as you go.
Okay. All right. So, Gareth, going after some of the hot stuff here to fade it down a little bit. Apple looking for BTC to take a hit once it gets to 25-ish. And then the other stuff that was winning coming into this year that's now down, healthcare stocks, defense companies. What do we do with that? I mean, if the froth up here is perhaps a little long in the tooth already, where do we put our money? Does anything look good? Does anything look appealing?
Yeah, so I'd be looking exactly like that. So one of the things, by the way, to mention is that today, with the market rallying very early on, one of the things that struck me was that the VIX was not falling dramatically like you would anticipate. And what that tells me is that big money is starting to accumulate protection by buying the VIX. And again, that's something to look for. So for me, that's exactly what I'm doing. I'm shifting into defensive names, a Lockheed Martin that's pulled back significantly recently, and other kind of defensive plays, while looking to short the high cap tech numbers that are coming out in the coming days over there with Apple and some of these other players that have seen big moves in the upside in the recent days.
Got it. Now, the longer term, when it comes to the crypto stuff, you still have some hope, but that's like long term. The real downside targets that we discussed earlier as being possible this year, 10,000 on Bitcoin, et cetera, do you still think that is a first stop before your longer term bull case?
I do. I still think that, again, what we're going to see is this kind of regulatory framework be announced. That's going to give a little bit of confidence to bigger investors. But the big issue later in 2023 is that we are going to see the economy entering recession. The S&P 500 probably does take a bigger leg lower. And my thought process is that as risk assets sell off significantly, Bitcoin and crypto will get caught up in that and ultimately see a big hit down. So 10,000 still looking like it's the downside in Bitcoin.
Okay. All right. Gareth, as we wait for the macro stuff to kind of light that flame that then causes a little bit of this explosion to the downside, is there anything here in the camp of growth, of tech, of beating down names that actually look like they deserve a second chance? I look at companies like Wayfair and Bed Bath & Beyond and Carvana rallying, and it makes me want to puke. Is there anything here that actually we can believe?
Yeah, well, you and me both. I mean, you see this resurgence of the kind of Wall Street bets kind of names, and that's something that, remember, that occurred just before the market topped late in 2021. So you have to look at that as a warning sign, like a big red flashing light in front of us as investors. So for me, I'm really staying very conservative right now, more geared towards those kind of the de-risking plays, the Lockheed Martins, as I mentioned, some oil plays maybe if they haven't run up too much, and then kind of playing defensive by going short some of the big tech names. But I would caution people, the VIX is concerning, as well as some of these other factors like Wayfair getting these big rips.
All right. Thank you very much, Gareth. Appreciate the insight.
Thank you so much. Take care.
All right. Happy New Year. Good to see you again. Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com.